Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is a follower of the Austrian School of Economics. He's a precious metals expert, and he's a paid consultant for gold and silver mining industry. David Jensen, thank you for joining me again.
Hello, Jason. Good to be back.
Now, David, I want to ask you about the state of the global economy from your Austrian School lens. You also travel around the world looking at different resource properties, so you get to see boots on the ground of different economies. What's your opinion of the global economy right now?
Well, I think the global economy is in a deflationary spiral of what people typically call deflation in terms of a declining output and dropping, until recently, we've seen dropping prices for commodities, and we expect to see this deflationary spiral due to the excess of debt that we have in the economy. We're around $220 trillion of global debt, and it's about 340% of global GDP, which is more than twice what it should be on a historic basis. So what we see from an Austrian perspective, if we look at it using the lens of what's called capital-based macroeconomics, this has all been predicted by the Austrian school to occur, and it was also predicted by John Exter of the Federal Reserve. He predicted that when America defaulted on the gold redeemability of its money for gold in the early 70s, that this would be the end result, that you'd have excess debt creation because there's no limit on the debt creation. In the end, you have collapse followed by hyperinflation. So, but the key is this capital-based macroeconomics. And what it says is that when you increase consumption by the creation of credit or debt, you actually create an imbalance in your economy. You increase your consumption without first increasing your productive capacity of the economy. And this creates a mismatch in terms of efficiencies in your economy and productive capacity. And it creates greater consumption than you can do it efficiently with your economy. And as you continue to increase the debt, it continues to increase consumption and distort the economy. Also leads to bubbles and speculative mania, as we've seen in our economies. But this is the whole fallacy behind Keynesianism and monetarism and the central bank theory that we're used to today. We're being fed by the mainstream economists that you just need a little bit more debt and things are going to look pretty good. We need negative interest rates now and things are going to get better. But the reason we're pushed into this situation is that the economies can no longer function with the credit creation. And the credit creation's got so large that in many cases we actually have negative growth of the economies and a contraction, even with large increases in borrowing.
Yeah, we have, to add to some of your points here, we have 12 trillion now in negative interest rates for global government bonds. One of the tenets of Keynesian economics was he said that consumer spending is good for the economy, increasing demand. The thing is, though, in the short term, maybe you can open up a new credit card and run up the credit card. But if you can't pay back the money and you're in debt up to your eyeballs, it's not good for the economy long term.
Exactly.
It makes society worse. But, this is why I don't like Keynesian economics. There's a lot of great articles on how Keynes created consumerism on the Foundation for Economic Education website. Our listeners can go search those articles. But yeah, I mean, Keynes is completely, opposite of the Austrian school, because the Austrians say what fuels economic growth and productivity, as you say, is savings and capital investment. So that's how you start a business. You start a business with saving. That's how you start making investments. You have to have a pool of savings in order to make those investments.
Right. If the listeners just do some research on the capital-based macroeconomics from the Austrian school, they will see exactly how the economy becomes distorted by growth of consumption through the increase of credit. The issue with Keynes is, and the monetarists for that matter too, is that you can create an increase in short-run consumption. There's no question about that. But you can't create real growth. And those are two very different things. You can't create real growth in your economy because of the distortions of the credit and creating excess consumption before you have an increase in the output and the efficiency of your economy itself.
Exactly. I completely agree. And Keynes created something called the Keynesian cross. He believed in aggregate. So he said government spending, consumer spending, investment,
Yeah.
all three of these things in aggregate were the same. They didn't matter as long as they occurred in the same amount, as long as they occurred in growing amounts. So he said, consumer spending was equal to private sector investment, and private sector investment was equal to government spending. That's how Keynes viewed it. That's called the Keynesian cross. That's what Austrians say is wrong. Monetarists also believe, for the most part, in this Keynesian cross.
Yeah.
So this is how, like, some of the basic tenets of why the schools are so different, and why I think society screwed up, because it's gone the way of so much Keynesian
Yeah,
economics.
the central fallacy with governments being productive and engines of growth is that governments cannot create growth. They have no asset allocation signal through the pricing signal from the economy, and as a consequence, they cannot allocate assets efficiently. And so, yeah, you can have consumption and you can make work programs, but you can never. Government cannot create productive output. And I mean, the fallacies between monetarism and Keynesianism and what are referred to as mainstream economic theory, and it's really mainstream delusion, is centered about this whole concept that you can create wealth from nothing, and you can't do it, and you can't. Governments cannot create wealth. They have no way to allocate their assets effectively, and they cannot know because they do not have the market price signal coming back as to what needs to be produced at any one time.
Yeah, and the Soviet Union failed because of this, and people say, "Oh, the Soviet Union." The people who defend what we have now will say, "Oh, the Soviet Union went too far. This mixed model economy is good. What we have now is fascism." It's the compromise, I guess, of what the Marxists wanted. Keynes was essentially a fascist, and they have a monopoly on interest rates and who controls the money and credit and who gets the easiest access and the cheapest interest rates to borrow, and that's the people at the front of the money trough, what the Austrians call the Cantillon effect. It's the U.S. government, and it's Wall Street, and it's the large corporations who get to borrow basically at zero, and they get the benefits of getting all the new money and credit creation first.
Yeah, Ludwig von Mises, who is one of the most famous Austrian school economists, he warned about there was no necessity entering a Cold War with the Soviet Union at the time. He says all you have to do is sit back and wait for them to collapse, because he knew that there was no asset allocation system in a government state-run economy. And he just said, just stand back, they will collapse. There's no, and this is why the domino theory in Asia and the whole Cold War was a totally unnecessary enterprise. If we had just maintained our positions, the Soviet Union would have collapsed with or without the military spending because of the government interference in the economy.
Yeah, I mean, I could discuss Austrian School Economics with you for a long time, but I want to transition now to the gold and silver markets for the rest of this podcast. You released an article on July 4th, only a couple weeks ago, called Detonation of the LBMA. It wasn't Brexit, Governor Carney. Why do you think that the LBMA is running into trouble?
Well, we're seeing a whole series of signals in the metals market, and these things it's occult information. It's not obvious information that you're seeing, that it's out in the open, and they're not saying, hey, we're in a crisis now. They're not advertising the fact. They're doing quite the opposite. But you get enough signals that you can see that there's problems, and I think that the one thing that's been a real key for us to understand is the Bullion Star article that came out last year that showed that the metal had basically been swept out of the City of London, out of the vaults outside of the ETFs and outside of the holdings of the Bank of England, that they were down to roughly 6 tons of gold, roughly 200,000 ounces, outside of the proclaimed holdings or the stated holdings of the ETFs and by the Bank of England. And for context, there's roughly 400 to 600 million ounces of claims in the London spot market for gold. So I mean, just seeing that alone, and the other thing is too that the metal that was taken out of London, it would be the last to be taken to the Swiss refineries, because of the logistics and just the added complexity of moving it from vaults in London onto aircraft and then flying it to Switzerland and moving it to refineries. The Swiss gold would have been the first gold to be refined and shipped. So that's when we see that they were running into serious problems in London. And we have, the admission by Deutsche Bank that there is manipulation of the gold and silver market. Also, we see this tremendous drawdown of silver in the COMEX as well. And then very recently, Marco Byrne of Goldcore reported that his sources in the London market said that there was a panic in the interbank gold market, that they couldn't get sufficient 400-ounce bars, which there should be no shortage of. So we're getting all of these signals that there's problems in the market. And we're getting some other things that are interesting as well. I noted this week that the Japanese corporation Tanada had bought Metalor refining in Switzerland, and that's one of the major Swiss refineries. And this comes roughly a year and a half after the Japanese corporation Asahi had bought Johnson and Matthey, which is probably the best known name in this precious metal space in terms of refinery. That's a 200-year-old company, and the Japanese, I would see they would be doing that if they were concerned about securing access to refined metal. There's no need to own a refinery if you can just go to a bullion bank or go to one of the exchanges. But when we see the malstructuring of the claims in the exchanges of, as I mentioned, of the order of 400 to 600 million ounces of gold, and even more shocking, I think, is in terms of the imbalance, is the 4 to 6 billion estimated ounces of silver claims in London versus world total stockpiles of silver of just 1 billion ounce. Let's use the 4 billion ounce of claims. I mean, the billion ounces of refined silver stockpiles held by ETFs and banks and other investment houses. I mean, that's refined metal, but it's not necessarily available for sale. It's held by owners. So you've got hundreds, if not thousands, of claims per ounce of silver that's actually available for delivery. So we're seeing, the Japanese now moving in to buy refineries. That guarantees them access to refined metal, and they certainly need the silver for their electronics industry, and you need platinum and palladium for their automotive industry because it goes into the catalytic converters of automobiles. So I think it's really interesting to see this all happening in a fairly short period of time. And so we're seeing all these pieces of the mosaic coming together to signal that there's disruption. And certainly hearing Marco Byrne say that there was a panic in the interbank market, there's definitely problems behind the scenes, Jason. And it's not surprising given the size of the claims in the London paper market and in the New York paper market as well.
Yeah, we're hearing also stories from the CEO of Avino Gold and Silver and also Keith Neumeyer, First Majestic Silver, of end users, people who need silver, physical silver for industrial use, who want to go directly to these miners and secure offtake agreements. So skipping the exchanges, skipping the refiners, they figure they'll do it themselves and get it done that way. So I think, to me, that's showing that there is physical supply problems in the market. Obviously, if you're a guy listening to this podcast and you can go down to your coin shop and buy coins or bars, you're going to say there's no physical problems. I'm talking in tonnage.
Yeah.
So I'm talking, 1 ton, 5 ton, 10 ton orders of these things is what industrial users may buy. And, they're not going to buy small amounts of gold and silver. They're not going to buy 10-ounce bars or 5-ounce bars or a monster box. They're buying tonnage. And the problem in this market now is tonnage. There was also a great video I think our listeners should take a look at from Jim Rickards and Egon von Greyerz. They were inside a gold vault in Switzerland. And Jim Rickards was talking about one of the largest Swiss gold refiners having problems sourcing physical gold, couldn't get doré bars reliably, and couldn't get the scrap gold needed to recast the bars and melt them and assay them down to the 4 nines of quality and purity into kilobars, which is what goes into the Chinese markets.
Yes. Yeah, it's and maybe to add a little bit to that, Jason. Yeah, it's very interesting. The electronics manufacturers have to have the silver. The high voltage electronics manufacturers have to have the silver because it doesn't spark. And there's the solar panel manufacturers, they've got to have it, and the automobile manufacturers have to have the platinum and palladium. And what I find very, very interesting is the move in the silver equities that have just taken off. I don't ever recall having seen this in the past, but if we look at the SILJ, the junior share index, it's up. It's 429% of what it was in the middle of January. And the SLVP, which is the silver producer index, is 330% of what it was in the middle of January. And then there's standouts like, for instance, Coeur d'Alene silver. It's gone up 846% in the last 6 months. I mean, it's just a stunning move, or 7 months. That just incredible the way that stock has taken off. So I see the very, very large movement in the producers, especially, that has occurred, a signal of a major phase change, that we're at a hinge point in the silver market. This is not just trading chop that's happening, but it's tremendous moves, and I think that we're only a fraction of the way into the move in the silver that we're going to see. But that is the metal that I see with the greatest imbalance in terms of the demand that is out there versus the tiny stockpiles, and with the extreme size of the open interest claims in London especially, but also in New York. I think we're going to see an epic change in silver coming up in the next few months.
Yeah, it looks like that the LBMA and COMEX are running out of physical metal, but COMEX can't, there's so many rules in the contracts to evade fully defaulting with COMEX that they can't technically ever default. They can cash settle. They can do so many different things to where the lawyers for these, both the exchanges and also the bullion banks and other counterparties involved, have protected them from actually really defaulting.
Yeah. And maybe we can just tie this back into the initial economic discussion. The skyrocketing price of monetary metals in what is supposed to be a deflationary initial environment, which is what John Exter predicted, followed by currency failure and hyperinflation. But the thing to keep in mind is that gold and silver are monetary metals, and with a 4,000-year history of being monetary metals. And what you would see in a deflationary environment, the common understanding of it that is used by the pop economists right now is basically falling prices or increasing buying power of money. But gold and silver are not commodities. They are monetary metals. They have some, silver especially has some industrial use, but it makes sense that you'd have skyrocketing prices of gold and silver versus the price of other goods, in terms of that rocketing price of gold and silver is signaling that gold and silver can buy more. And so what that's really signaling is that your currency, which is gold and silver, is becoming stronger versus other assets in a deflation. So it's not surprising for me to see this. And so many people look at gold and silver as commodities, or they've been schooled to do so by the media and the standard economics that are out there. But when you look at them as money, it makes sense that they would become far stronger and would have much more buying power in a deflationary, declining environment.
Now, you mentioned Gibson's paradox in your article. Can you tell our listeners exactly what that is? And do you think that means then that there's been a very strong concerted effort to manipulate gold and silver paper prices for a very, very long time?
Yeah, Gibson's paradox was basically that it was the focus of a paper in the mid-'80s by Larry Summers and Barsky. Larry Summers went on to become Secretary of the Treasury, but Gibson's paradox stated simply is that interest rates don't respond to rising consumer goods inflation rates, but that they respond to a rising price level. And what the price level is indicated by is typically the price of gold. So, I mean, what it reduces down to in the end, and Summers was very clear about this in the paper, is that rising gold prices force interest rates up. And this is what I think that we're going to be seeing. I think that there was a very good interview done by Jay Taylor and Michael Oliver either yesterday or the day before yesterday, I believe. And today is July the 15th. But if you search that out on YouTube, Michael Oliver feels that we're at a tipping point in the bond market where yields are going to start going up, meaning that the bond market's going to sell down. And that would go along with the rising precious metals, which was indicated, or gold in particular, which was the indication of the Gibson's paradox analysis.
Yeah, it seems we're getting to a tipping point in a lot of markets. Volatility starting to increase. The bond market's been in a bull market, especially U.S. Treasuries, for decades now, over 3 decades, I believe. But yeah, I mean, they've been playing so many, in my opinion, playing so many games with manipulation in the paper gold and silver price. And people are like, oh, gold and silver going up now. Well, there's always these key attack levels in a managed retreat where they play these games. Like I remember in 2011 when silver was about to break through 50 and make a new all-time nominal high. The margin requirements for owning silver COMEX contracts, I think they increased them more than 10 times in only a couple days. So, when you see these types of manipulation games, and, the exchanges like the COMEX and others always give excuses for why they're increasing the margin requirements. Oh, we need to make the market less volatile or this or that. The excuses that they give are never the real excuses.
No.
Because we were talking before we started recording, you talked about the normal leverage ratios for delivery of paper to metal in the COMEX. So for them to say, oh, we need to increase margins now, they normally never have to deliver the metal anyway.
No, it's about 0.04% of the metal traded in New York is in the COMEX is actually taken in the form of physical delivery. So the markets, they're just prices of metal promises, and they're they really don't give I do not like to follow the price charts of gold and silver because the markets are manipulated. And the bottom line is when that market breaks, I believe that they're going to have to add a zero to the price of gold and silver, and that'll be the starting point for the run, and it'll go up from there. So it's I really discourage people from tracking the price of gold. It's a manipulated market, and I personally don't see value in closely following the price trends in the paper market. These are markets that are in the process of failing, and they're going to break. And when they do, we're going to move to a new pricing regimen. And on that note, it's it was of note to see today that the TOCOM, the Tokyo Commodities Exchange, announced today that they're going to start a physical gold contract for physical settlement in Tokyo. And that they're also going to go to a spot contract where you can take physical delivery. In the past, you were only able to have cash settlement there. So we're seeing more and more markets moving in the physical direction, and I think that everything is moving in the same direction in terms of these signals, and that we're going to see a new market come out of this, and I think it's going to be very surprising for the vast majority of people who see this as just irrelevant things, and look at gold and silver as jewelry, and really don't understand the monetary link and the connection to interest rates.
There's strong demand for physical gold in Japan now as the Bank of Japan's central bank, attempts to destroy their currency, drastically devalue it. I think, Ben Bernanke was just over there talking to both Abe of Abenomics, the Prime Minister of Japan, and also the head of their central bank, telling them that they should do a 10 trillion yen helicopter money drop. Obviously what these Keynesians, I think, like to do is when their policies don't work of QE or money printing, they just say, oh, it wasn't enough. We have to do an even larger size. So I think they're always doubling down, and the consequences, just take an order of magnitude and dire. But in terms of the manipulation for the gold and silver market, I mean, the judge just dropped 3 class action lawsuits against JP Morgan for manipulating the silver market. What the judge said was there wasn't enough legal proof done by the hedge funds and other people suing them that JP Morgan intentionally made uneconomic bids on the exchanges.
Right. Well, I mean, we'll see when Deutsche Bank's finished with their testimony, because JP Morgan is at the heart, or one of the banks at the heart of the gold trade in London. And this is not the end of the story by any means. And I refer back to Ferdinand Lips's book Gold Wars too, and that he spoke of going and visiting with J. Aaron and company from Goldman Sachs subsidiary, and he was realizing then that Goldman Sachs was at the center of the advising the central banks on leasing out of their gold and selling their gold, and he obviously, Ferdinand Lips, from his book Gold Wars, he didn't make the linkage between dropping gold prices and dropping interest rates, which I think is what was the real interest. But the story is not told here. Dropping of charges against J.P. Morgan. I mean, I haven't read the statement of claim and the filings in that case, but this isn't over by a long shot, and we're seeing the market starting to tremble. And I think there's a massive change coming in the gold and silver market ahead of us.
Yeah, David, I think there's so much physical supply problems. Did you see that the first half Shanghai Gold Exchange withdrawal numbers that Jensen gave us the research for? I think it was only, let me just pull up Kuz's article here, it was 973 tons in the first half of 2016, which is a lower number. But what I think that's telling us is there is physical supply problems for physical gold and tonnage, and there is more competition to buy that physical gold available, the annual gold mining supply, et cetera, it's not just China and Russia in the market now trying to buy the physical gold like it was when the charts were bad a couple years ago.
No, I mean, the insurance companies have, Munich Reinsurance has entered the gold market. I mean, the insurance companies are being destroyed by these low interest rates. And, they're eating up their principal to make payment on annuities. And it's just, they can't tolerate this much longer. And they're starting to move into the gold and silver market. Or the gold market anyways. So, I mean, and these companies hold trillions of dollars of assets. So as they start to move into this market, they're going to take it to another level as well. So I suspect that is part of of what Mark O'Byrne referred to as the panic in the interbank market for 400-ounce bars. I think it may well be related to these insurance companies coming in and taking delivery of the metal. They've got no problem storing it themselves, and I'm sure that they're all well aware of the gaming that goes on in the exchanges, and that there's not really gold or silver available there to speak of in terms of the spot market.
Yeah, and there's also billionaires who are publicly saying they're buying gold. So they have a lot of them, like Druckenmiller and Soros and things like that, have said that they bought GLD, but they don't have to publicly disclose that. They opened up an account with Egon von Greyerz and put $20 million in there to go buy physical gold bars and store them, in a safely in the most secure vault in Switzerland. So they don't have to publicly disclose their physical gold holdings like that are often exchanged.
Well, and investors in GLD can also take delivery. I believe it's 10,000 ounces at a time delivery of gold.
That's what it says in the prospectus, but I know people who have tried to do that and they were told to go F themselves by the the custodians, the bullion banks. Yeah, so I know some hedge fund managers after 2008 that tried. Grant Williams was one of them, and another friend of a friend was another. So yeah, they had more than 10,000 shares, and they had, I think, over $50 million worth of gold in there.
Yep.
And the custodians at GLD told them, you can't take out the metal, screw you.
Maybe it's just the insiders that get access to that.
Well, yeah, I think it is the insiders, David, because what I heard was when the paper gold and silver prices in U.S. dollars, from the 2011s to 2014s during the heights of the bear market, the gold price in India was actually going crazy. I had heard from different sources in the gold market that the custodians, so the Wall Street investment banks and the really insiders in GLD, they were pulling lots of physical metal out of it and selling it on the Indian black market for $100 or $200 an ounce premiums.
Right. Well, I'm sure if George Soros wants to get 10,000 ounces of gold out of GLD, they'd be more than happy to deliver to him.
Yeah, maybe because of his political connections, but a regular billionaire who's not as politically connected as George Soros, I don't think he would, because there was a couple very, very high net worth people that did try to get it. Yeah. King World News and others reported on this years ago. Right. I want to ask you now, David, though, about the gold and silver mining industry. Since you're a consultant, you go visit mine sites. I think you're an investor in a lot of these companies as well. Do you think the copper miners are going to go bankrupt? The copper miners going bankrupt and shutting down their mines, is that good for silver prices?
Well, for gold and silver, I mean, yeah, the base metal miners in general. Copper. A lot of gold production comes from these copper gold porphyry deposits, and I think it's of the order of about 60% of silver comes from base metal mining, and I think another 20 or 25% comes from gold mining. So yeah, for sure, the dropping metal prices, you're going to see slowing down of consumption of these metals and then slowing down of production of silver. Silver in particular is very sensitive to this because there's only a billion ounces of stockpiles above ground versus the roughly 850 million ounces in round numbers of production per year. So, I think that slowing base metal production is going to start to restrict production of silver, and I think also that rising prices, strangely, in terms of gold and silver, can cause a decline in output, and that the reason for that is that the mines are operate on a fixed throughput basis of ore, and as the prices start to go high, many of the miners go and start to mine some of these low-grade zones that weren't economic in the past. So they start moving into areas, lower grade areas, which become economic with a shorter term view of just trying to get this ore to market while it's still economic. And they produce actually less metal in these low grade zones. So spiking metal prices can actually lead to slowing metal output from the miners. And as I said, in particular, that could impact the silver market in terms of miners chasing low grade zones.
Yes, and a higher metals price, David, could also hurt the margins of some of these gold and silver miners who have done too much high grading, and then they start bringing on their lower grade ore, and their costs start rising and things like that. So, that was a problem that we had after the 2008 crash. From 2009 to 2011. A lot of the gold and silver miners didn't make the margins and free cash flow and pay out the dividends that a lot of shareholders were expecting them to.
Well, there was also extreme increases at the time in terms of operating costs and fuel as well, right? We went to $150 a barrel for oil, and typically for a large open pit mine, you're running about 35% of your inputs are energy costs. So there was a very, very strong increase in production costs, both on the capex side and on the cash cost side of production. So there's all kinds of things that happen in a mine. It's not just like turning a screw and getting more output with higher prices. There's varying inputs and various things to consider.
Now, do you think the gold and silver miners have done a good job of cutting costs since 2011?
I think the ones that didn't do a good job of cutting costs have gone bankrupt and are not in business anymore. So I think the ones that are around now were the successful ones, who were able to, it didn't matter when gold was rising sharply and was heading towards $1,900 an ounce. It didn't really matter much. You just added capacity, and it was basically just stroking checks. But in the falling environment here, it's taken quite a bit of artful work to lower costs. But I mean, I went to the Goldcorp annual general meeting, and they're totally focused now on looking inward and focused on efficiencies and focused on their reducing their cash costs of production, and really right now is one where you want to be looking outward and acquiring very large, especially for the majors, gold projects, which may only be marginally profitable, but which will become extremely profitable if you understood the gold and silver market in a rising price environment. So, these majors, to me, just watching them blunder around as they have for the last, decades, Goldcorp's price has been basically flat over the last decade. They're really focused on the wrong strategy right now, which is they're turning inward and retrenching at a time where they should be looking outward and preparing for a sea change in the gold and silver market that they're in.
Well, there's been a lot of capital raises by a lot of miners and some royalty and streaming companies in the last month or two. Some of it's done to pay off bad balance sheets. Some of it's done because some of the CEOs are very skeptical about the rise in gold and silver prices, and some of it's being done for acquisitions and growth. You brought up Goldcorp, though. I mean, didn't Goldcorp just do an acquisition in the last 2 months? I think it was a junior. I don't know if it's going to add a lot of ounces of production to them anytime soon, but you think, though, that they should have did an even larger acquisition?
Well, I think if you understand the metals market and that we're heading into a much higher priced environment, you would like to secure good large assets in safe geopolitical jurisdictions. And Goldcorp over the last decade has been turned into a mini Barrick in many ways, in terms of their asset locations, in terms of geopolitical stability. And yeah, you should be acquiring safe, large assets, which may even be just marginal assets. But if they're large enough to participate, to go into production in these higher priced environments, I think they should be looking forward, not backwards. But I've been through a number of these technical report exercises, and you typically apply a 30% discount to the current price. And I was listening to the discussion at the AGM, and they were talking about the jewelry market and all this, and they were saying that they thought that it might be gold's time, but they weren't sure. And so, I mean, they really don't have a clear view on what's going on, and as a consequence, they don't have a clear strategy in terms of how to grow that company.
Well, that's because a lot of gold mining companies won't admit that there's gold and silver manipulation, and a lot of them trust, the research of the World Gold Council. They believe in, the demand statistics. They don't look at that all the physical gold demand that's coming from the Shanghai Gold Exchange, all the withdrawal numbers. They don't look at that because a lot of the Wall Street investment banks, they know demand's coming from the Shanghai Gold Exchange withdrawal numbers, but they don't report on it.
Yeah, it's remarkable. The World Gold Council is financed by the miners, and they only look at Chinese retail demand for gold. They ignore the 7 million individuals in China who buy gold directly from the Shanghai Gold Exchange, and it's on an annual basis. It's in round numbers 1,000 tons or 30 million ounces that the World Gold Council ignores. And so they come back year after year saying, well, demand is fair to middling. It's looking okay. It could drop. And meanwhile, for the last 5 years especially, there's been a 5-alarm fire in the gold market, and the metal's been absolutely swept away by this, much of it by this intense buying in China, but not all of it. But I just find it's risible that these major gold miners are financing companies which distort the story and hide the true value of their assets, to the detriment of their corporations and their shareholders, and really society as a whole, if you consider the detrimental impact of suppressing gold and silver prices and spinning debt.
Yeah, I think Jensen tried to contact the World Gold Council and ask them why they didn't include the Shanghai Gold Exchange withdrawal numbers, and I don't think he was given a very satisfactory response.
I'm sure it doesn't surprise me if he wasn't. I mean, it's just ridiculous to ignore 30 million ounces a year that's being taken in China, directly from the Shanghai Gold Exchange and bought by 7 million investors, and to say, well, we don't count that stuff. And given that we don't count it, the market's looking kind of, not too bad. It might pick up next year, but we'll see. Meanwhile, the metal is being absolutely swept out of London and New York and Switzerland and just disappearing from the scene, and the Western investors are none the wiser, and they're going to be left short in the end.
Yeah, and there's been also a lot of central bank buying from Russia, from the People's Bank of China in probably different exchanges. They've probably been trading their dollars either at the LBMA or on the COMEX or different locations in order to buy physical gold and silver as well.
Yeah, I mean, there's many stories about China also. We're offering actually a premium on doré bars, that they were offering a premium to spot. But I was discussing this with a friend, Larry Parks, and it's just remarkable that they're buying unrefined gold at a premium to spot. But what happens is when you're buying the doré, but from Africa and other places, is that's really it's offline. It's not visible purchasing, so you can do it, in a secretive manner where the market's not picking up on it. So, I mean, China very well knows where the price of gold is going, and it's not down, and that's why they're doing these things. They're preparing themselves and their citizens for a new monetary system which is coming at us. In the West, we'll be responding after the fact as opposed to preparing for it because of our government policies and financial industry policies.
Yeah, and that also probably helps explain why a number of Swiss gold refiners are having problems sourcing doré bars, because there's so much competition for buying doré bars.
Yeah.
From China, like you said.
In general, yeah, there's competition for gold now. There's enough. There's enough purchasers of gold at the margins that can make a difference in the market. It's still a small market because of the price suppression.
Yes, and now that the chart's good, for gold and silver and gold mining stocks, Western investors who normally aren't value investors like in China for buying gold and silver, Western investors are now going to start rapidly buying because supposedly, some of these gold trusts, GLD supposedly added ounces of gold. I don't know if show me an audit, show me an independent audit proving me you added it. But other gold trusts have been saying that they've been adding physical gold too, and there's been a lot of other physical gold purchases by Western investors now that the charts of these of the paper gold and silver are better.
Yeah, I think it was Jensen or Ronan Manley. I can't remember which one, but one of the two of them there from Bullion Starters came out with an article noting that the GLD holdings, that much of the increase in GLD holdings were actually held by the Bank of England as a sub-custodian. So, and they've gone through the documents of the GLD and found this. So it may well be least sovereign gold that GLD holds title to. And it was interesting this week. It's been announced that that a Bank of England employee, Dr. Fisher, is going to become the new chairman of the LBMA. So basically, Bank of England is taking the LBMA under control. But I think there's lots of loose ends there, and I just don't think that the problem that they have there is going to be rapidly soluble given the games that have been played in that market.
Do you think we're at current gold and silver prices now where we're going to see a lot of new gold and silver mines built, or do we have to see a lot higher prices going forward before miners, large capex projects get all the funding they need to build mines?
Yeah, the market's just starting to wake up. The investors are still punch drunk from the last, the drill down from 2011. In the price, and they're coming in at the margins. It's exciting for the companies that are starting to raise money, but it's nowhere near what it was back then in terms of capital that's available. And I think that the majority of the mining companies don't understand the nature of their own industry and the nature of the market and the demand that's coming at them. So many are just sitting back saying, well, we'll see how this goes.
Yeah, I think a lot of the gold and silver mining executive CEOs, they won't admit that gold and silver are manipulated. They don't understand the real fundamental supply and demand statistics for it. They don't understand the demand coming out of China with the Shanghai Gold Exchange and different things like that. So, they just quote World Gold Council numbers. It's pretty frustrating to me. I've had talks with some IR representatives and some mining CEOs, and, off the record, not on an interview, on a podcast or recording like this, some of them will admit to me gold and silver are manipulated, the paper prices, but, the bankers basically have them by the short and curlies. And I think this is a situation that the miners who had too much debt and had hedges they got into, we were talking about this before we started recording. You said in a perfect world, when the gold and silver paper prices got low, the miners should cut production and stop giving away, their highest grades, best margin ounces at such low paper prices. But, when you have so much debt outstanding and you have hedges, you're forced to service that debt. The bankers basically own the miner then if they have too much debt or hedges.
Yeah, but the miners, pardon me, could deal with it in a different way, in that they are the lifeblood of the LBMA in London, which is the pricing platform for the gold they produce. They almost all use the price that's developed on the LBMA, where they're trading 200 million ounces of gold a day and 1.8 billion ounces of silver a day, and it's complete fiction. And what the miners could do is start a miners exchange for selling gold in an open and honest auction, and that would bring the LBMA to an immediate stop, and it would have. But it's incredible what the majors are doing here in terms of their activity and the destructive practices they have in terms of, they are the lifeblood for the exchanges that are destroying the price discovery for the assets they're selling. And as soon as they stop doing that, or even a few of them stop doing that, it brings that game to a close. And it's just amazing to watch the paralysis in the terms of the thinking of the management in the majors.
Do you think the gold and silver fix that's coming to the Shanghai Gold Exchange, do you think that's going to be more transparent and help get a more better price, real price discovery for the physical gold and silver market compared to the LBMA and the COMEX?
Yeah, I mean, there are websites that now give you a live differential between the Shanghai price and for gold and silver and the London and New York price, the Western price. And silver, I've been watching it for the last week, has been running between 20 and 45 cents premium in Shanghai. And what that's going to do is draw the physical metal to China out of the West. If you look at the cost of sending a shipping container from New York or London, and then add in some transportation costs and insurance and other things that are involved in shipping silver, for instance, you can put 50,000 pounds, roughly 700,000 troy ounces of silver in a shipping container and ship it. And the net cost of shipping it, including the transportation by truck and insurance, is of the order of 2 to 4 cents an ounce. So when they're running 20 to 40 cent premia in Shanghai for a prolonged period, it is sweeping the silver out of the West. And it's doing the same thing with gold as well. So yeah, it is going to choke off the metal supply, but it's not just China who are buying the metal either. And as I mentioned earlier, the insurance companies are starting to buy gold because they realize they're being destroyed by holding zero or negative yield bonds in the bond market.
Yeah, this is a good point. I think negative interest rates, the Keynesian central bankers, so, the Federal Reserve Chairman, the Bank of England, the Bank of Japan, they didn't realize when they started going to negative interest rates that it's actually good for gold.
Yeah, well, I think they knew it, but I think that they've been trying to ignore it because their problem with the debt markets is so large. And it's just typical thinking that, low interest rates didn't really work out. So, for sure, negative ones are going to be even better. And they don't understand the whole concept of capital-based macroeconomics and how low interest rates destroy the productive capacity of an economy. And that's what we're heading towards.
Well, David, central banks shouldn't be setting interest rates anyway. The market should be. There should be a free market price on interest rates. The market should decide what the interest rates are. It shouldn't be, 12 PhD economists who went to the same handful of schools and have known each other for years and have read pretty much the same books, all deciding how to tweak interest rates, in their secret meetings where they release, politically constructed minutes.
Yeah.
That are like really bad political speeches.
Well, central planners do everything else so well, so why shouldn't they also price interest rates? No, I mean, the only way to set the interest rate is for the demand for money from the economy, and a group of revolving door financial industry people setting the interest rate is it's a farce. You can't even look at it and pretend it's a good idea. And the hole they've driven us into, they're basically smashing our economies, and people don't realize it. Well, they're starting to wake up to it, but it's going to have an extraordinarily destructive impact on our society. And it all started with the decoupling of our money, our currency, from gold. Just as John Exter warned us that it would destroy the value of the money, and it would create excess debt that would collapse the economy and ultimately would collapse the currency. So it is what it is, but it's extremely unfortunate what has happened.
Yeah, after 1971, when the last vestiges of the gold standard were ended, the international gold standard, because obviously Americans had been banned from owning physical gold since I think 1933, when FDR forced Americans back into the dollar and they had to exchange their physical gold for dollars again. We saw the over-the-counter derivatives market just explode. That's where they hit a lot of the inflation that was created over the years. We saw new credit bubbles. We saw new asset bubbles. We saw, new money printing programs go all over the world. The U.S.'s best export, David, unfortunately, for decades now, since the gold standard was severed, has been U.S. dollars to other countries.
Yeah.
just printing them off and shipping them over there.
Yes.
Okay. Well, I really enjoyed this interview, David. I'm going to attach a link to your article for our listeners to read. You regularly write on Safe Haven?
I do. Yeah. Also, I've been posting at Gold Eagle and 24 Hour Gold, and SGT Report picks up these articles and distributes them. So it's fairly, just if you just do a search on the name Jensen and gold, you should find some of these sites start to pop up.
Yeah, well, the next 6 to 12 months are going to be very exciting in terms of the U.S.'s election and what's going to happen in markets going after that. You know, it's not going to be for the faint of heart.
No, it's watch silver. I think that it signaled us in January, and it continues to signal to us that there is a major phase change happening in that market. I've been speaking about it and talking about these equities are sending us a signal that there's major change coming. And certainly when you have Coeur d'Alene up, trading at 840% higher than it was in January, something is going on. So do keep a look at these stocks and keep a look at the major producers, because I think that they're going to go to levels that you can't even, I mean, this is after a 40% rise in the price of silver to $20. I think that the next stage of the move is going to be a very, very surprising move in terms of the rate and the height. So, and it makes sense from my standpoint that silver would be the one to move because of the unbelievable mismatch between the demand in the terms of the spot market claims versus the physical metal that's above ground for delivery.
Yeah, I think silver is setting up for the perfect storm. If there is a weaker U.S. dollar, the demand for silver still seems pretty strong, with the electronics guys wanting the silver, and investment demand for silver pretty strong. And then on the supply side, I don't think there's going to be a lot of new primary silver mines being built. And I think a lot of that silver byproduct, like I said earlier, I think, there's going to be a lot of copper miners in the next 2 to 4 years that are in major trouble. They could, go completely bankrupt, and then all of their silver byproduct comes offline then.
Yeah.
Okay, great. Well, I want to thank you for your time, David. I always enjoyed your discussions, and we'll have you on again to speak about the gold and silver market.
Sounds great. Thank you, Jason.